Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Lightwave logic.
If you find our talks useful, please consider subscribe, like, and comment underneath. And make sure to check out the VIP Algos link below in the description. It's, a fantastic tool for this kind of research.
Oh, absolutely. Definitely check that out.
Right. So how does a company with negative 8,700% net margins achieve a valuation of nearly $1 billion?
Yeah, it sounds like a typo, doesn't it?
It really does. I mean, if you spend any time looking at the current tech landscape, the market can produce some pretty bizarre math. But today we are unpacking a scenario that just, it bends the traditional rules of wealth building entirely.
It completely throws them out the window.
Exactly. We're looking at a deeply polarizing tech stock trading under the ticker symbol LWLG. And the mission for us today is to figure out if this pre-revenue deep tech enterprise is like the foundational breakthrough the artificial intelligence industry desperately needs, or if it's simply a massive gamble.
That tension right there between necessity and speculation is the perfect lens for this. We're looking at a company that sits at the exact intersection of a very real physical crisis in computing and a financial profile that requires an enormous leap of faith.
Right.
To grasp why the market is assigning a billion-dollar valuation to those kinds of margins, we kind of have to look past the financial spreadsheets for a moment and look at the physical reality of the AI boom.
Let's set that stage for the listener then, because, everyone knows AI requires massive computational power. We hear about the chips constantly, right?
Yeah.
NVIDIA this, AMD that.
Right, the chips are getting incredibly fast. The graphic processing units, the GPUs, they process information at speeds that were literally science fiction just a decade ago.
Yeah.
But the massive build-out of AI infrastructure is hitting a physical wall. We are facing severe data center bandwidth bottlenecks.
So it isn't a problem of the brain thinking fast enough. It's a problem of, the nervous system getting the signals out to the rest of the body.
That is a great way to visualize it. Moving massive data sets from one rack of servers to another is choking the entire system.
Just structurally.
Exactly. The current hardware connecting these lightning-fast processors generates way too much heat. It consumes an unsustainable amount of power. And, on a purely physical level, it is just too slow to keep up with the GPUs.
Wow.
So the entire tech market is desperately seeking hardware solutions to widen those pipes.
Okay, let's unpack this, because before we dive into the wild financials, I really want to establish a firm baseline on the actual fundamentals here. We know they are targeting this bottleneck, but what is Lightwave Logic's actual competitive moat? From everything we're seeing, it seems to hinge on proprietary material science.
It does. The foundation of their moat is a really specific branch of chemistry and physics, electro-optic polymers, and silicon photonics.
Okay, that sounds intense.
It is. But to understand why it's valuable, just consider how data actually moves. In a modern data center, electrical signals from a computer chip have to be converted into light to travel down a fiber optic cable.
Right.
The device that does that translation is called a modulator. You can think of it like an incredibly fast microscopic shutter, flashing a light on and off billions of times per second.
And I'm assuming the materials currently used to build those microscopic shutters are part of that physical wall you mentioned earlier.
Exactly. Right now, the industry standard relies on crystalline materials, things like lithium niobate or indium phosphide.
Those sound heavy.
And expensive.
They are rigid crystalline structures. So to force those crystals to change their optical properties, to make that shutter open and close at high speeds, you have to blast them with a relatively high amount of electrical voltage.
And high voltage means heat, right?
Huge amounts of heat. It draws massive power. And there's just a physical limit to how fast you can force a crystal to react.
So what is Lightwave Logic doing differently?
Well, they took a completely different approach. Instead of rigid crystals, they developed proprietary organic polymers.
Organic polymers, so plastics essentially. Engineered molecules, right? Engineered at the molecular level to be hyper-responsive to electricity.
Yeah.
Because of their molecular design, these polymers change their optical properties with a tiny fraction of the voltage required by legacy crystals.
Oh, wow. So lower voltage means significantly less heat.
Less heat means they can be packed much closer together. And they can cycle on and off at speeds that traditional materials simply cannot physically match. They are building a fundamentally cooler, faster bridge between electricity and light.
So just to clarify this for you listening and to make sure I have my own head around it, Is this essentially like the upgrade the telecom industry made years ago?
Yeah.
Going from old copper telephone wires to fiber optic cables, but happening on a microscopic scale inside the actual AI server rack.
That underlying philosophy is identical. You're removing physical resistance from the system. Just as copper wire degraded signals and generated heat over long distances, traditional crystalline modulators are creating a heat and speed bottleneck at the microscopic level.
Right.
Moving to these polymers removes that friction, allowing the entire network to accelerate.
Okay, that makes the fundamental technology sound almost inevitable. But I have to push back here.
Go for it.
I was reviewing the financials, and I literally had to rub my eyes. If this proprietary polymer is the ultimate bottleneck solver for the biggest wealth-building tech gold rush of our generation, why isn't this company swimming in cash today?
Because the timeline for hardware innovation, especially at the material science level, is notoriously unforgiving. You don't simply invent a miraculous new polymer in a lab and, mail it to an Amazon or Microsoft data center for them to just plug in.
Right, it has to integrate with existing multi-billion-dollar ecosystems.
Exactly. The integration process takes years. The material has to be validated for reliability. Can it survive the extreme temperatures of a server farm for 5 years without degrading?
That makes sense.
Then it has to be prototyped. Then those prototypes have to be integrated into the complex silicon architectures designed by other massive tech companies. Lightwave Logic is currently deep in that commercializing prototype phase.
Which brings us to the financial whiplash of funding a deep tech company through that multi-year desert. I want to walk through these numbers because they seem entirely contradictory.
They really do.
On the top line, growth is exploding. Revenue is up nearly 176% trailing 12 months year over year, which sounds amazing.
What's fascinating here is that percentage looks phenomenal until you look at the raw dollars. That massive percentage growth is occurring on an exceptionally tiny revenue base.
Oh, I see.
Yeah, we are talking about early-stage engineering contracts or small batch prototype sales, not mass commercial deployment.
Okay, that context makes sense of the first contradiction, but the second one is even stranger. They boast a gross margin of nearly 97%.
Right.
When I see 97% gross margins, I think of software companies selling digital downloads, not a company manufacturing physical hardware for data centers. Make that make sense for me.
That 97% figure reveals their ultimate business strategy. Lightwave Logic does not intend to build giant factories and manufacture millions of physical modulators themselves.
Oh, they don't?
No, they operate on an intellectual property and licensing model. It's often referred to as a fabless model. They create the proprietary chemical formulation, the secret sauce polymer, and they design the blueprints for how to integrate it.
Oh, okay.
Then they basically license that technology to the giant hardware manufacturers who already have the fabrication plants.
So they just collect the royalties on the underlying science.
Exactly. Which requires almost no physical overhead per unit sold once the technology is commercialized. That's why the gross margin looks like a software company. The cost of goods sold is virtually zero.
But then the floor completely falls out when we move down the income statement, because while the gross margin is 97%, the net margin is negative 8,700%.
Yeah.
And they are posting a diluted earnings per share of negative 15.7 cents.
For a growth stage deep tech firm that's pre-commercialization, those numbers are standard operating procedure. The gross margin reflects the tiny amount of prototype revenue coming in, while the net margin reflects the massive ongoing weight of their research and development costs.
Because labs aren't cheap.
Right. They are paying teams of PhDs, running advanced photonics labs, and pursuing patents globally.
Standard for a startup, perhaps. But the market capitalization sits at almost $917 million. That gives Lightwave Logic a jaw-dropping price-to-sales ratio of over 3,770.
It's massive.
Look, if you saw a PS ratio of 3,700 in your own retirement portfolio, you'd assume the brokerage app was glitching.
Yeah.
You could buy a hot dog stand that makes $1,000 a year in revenue for $3.7 million, and you'd have the same fundamental valuation.
Yeah, it's a wild comparison.
So what exactly is the market paying for today?
The truth. The market isn't paying a single dime for what Lightwave Logic is doing today. Investors are entirely focused on catalysts, specifically the path to 2027.
3 years from now.
Wall Street analysts aren't even bothering to model near-term GAAP profitability. It's considered totally irrelevant. The entire bullish sentiment, and there is a surprisingly strong one, including a 7 out of 10 bullish score and an $11 price target, hinges entirely on getting these prototypes validated.
Validated by who?
By Fortune 500 companies and live AI environments by that 2027 window.
Okay, that future horizon brings up one of the most fascinating catalysts we need to talk about, the speculative side of things.
Oh, the rumors.
Yeah, the unconfirmed rumors of specific Fortune 500 design wins. There is a very specific phrase that keeps popping up, the Marvell-Polariton setup.
Right.
It sounds a bit like a maneuver from a sci-fi movie, honestly. What is that actually referring to?
That phrase unlocks exactly how this technology gets to market. AI hardware is an ecosystem of nested components. Marvell Technology is a massive semiconductor company. They design the ultra-fast chips, the brains that route data. Polariton is a highly specialized company that builds plasmonic modulators. They build the physical engines that convert the electrical signals to light.
And where does Lightwave logic fit into that stack?
They provide the fuel. The rumor, or the setup being speculated upon, is that Lightwave's proprietary polymer is being tested as the active material inside Polariton's modulators.
Which are, in turn, being tested to work alongside Marvell's silicon.
Exactly. If Lightwave logic gets integrated into a Marvell reference architecture, they suddenly become a default component for the broader AI infrastructure market.
It's a Trojan horse strategy. You don't have to sell to the entire market if you become a crucial component of the engine everyone else is already buying.
Precisely.
But if that massive ecosystem-wide payoff is slated for 2027, what happens over the next 3 months? What are investors looking at while they wait?
The immediate horizon is entirely about breadcrumbs. Upcoming earnings calls will not be about revenue beats. Honestly, a sudden spike in sales would actually be shocking.
Right, because that's not the phase they're in.
Right. Institutional investors and analysts will be scrutinizing the calls for R&D progress, any updates on the rate at which they are burning through cash, and highly specific technical details on where they are in those prototype testing phases.
They are essentially listening for proof that the 2027 timeline hasn't slipped.
And we also have to factor in the broader macroeconomic environment as a catalyst. Any pivot toward interest rate cuts acts as rocket fuel for speculative pre-revenue names like this.
When the cost of borrowing capital goes down, investors are historically much more willing to place bets on distant, high-growth horizons.
Okay, knowing that the massive theoretical payoff is still years away, let's shift to the technicals. Let's look at how traders are behaving with the stock right now, because the chart is an absolute roller coaster.
Volatility is the defining characteristic of this asset class.
Here's where it gets really interesting. The stock is currently sitting at $5.95. That is a steep drop. It's down over 68% from its 52-week high of roughly $18.70.
A massive pullback. A pullback from what looks like a period of absolute euphoria. But then you zoom out, and year-to-date, the stock is actually up over 92%. And it has a high beta of almost 2.5, meaning it moves far more aggressively than the broader market.
That beta metric tells you everything about the stock sensitivity.
Yeah.
It is totally tethered to the broader AI narrative. If an AI hardware giant announces a delay in their new chip cycle, Lightwave logic gets punished.
Oh, yeah.
But if there is a breakthrough announcement regarding data center expansion, the stock suddenly gaps upward. It's hyper-reactive.
Let's talk about the sentiment, because the data gets incredibly nuanced here. Let's look at the insider flow. The people who actually run the company and know exactly what is happening in the labs.
Always a crucial indicator.
Over a recent 90-day period, there were 6 separate insider buying transactions, but only 2 insider sells.
So a higher frequency of buying.
Yes, but the net change in shares was negative 29,785. So more individual executives are buying, but a larger total volume of shares was actually sold. On the surface, if I see the share count dropping from insider accounts, I just assume management is dumping their positions and heading for the exits.
It looks like a massive red flag until you apply a specific diagnostic tool called the Insider Management Stock Performance Ratio, or MSPR. Despite that negative net share count, Lightwave's MSPR is sitting at an incredibly high 99.03.
Walk me through what that actually calculates, because it seems completely counterintuitive to a negative share count.
MSPR evaluates the quality, timing, and distribution of insider trades, rather than just looking at the raw volume of shares moved. A score of 99 strongly indicates exceptionally high consensus confidence among the management team.
How does that work if they are selling more than they buy?
You often see this pattern in companies that have been in R&D mode for over a decade. You might have 1 or 2 founders who hold massive blocks of stock who sell a portion for tax purposes, or, simply to diversify their personal wealth after years of illiquidity. That accounts for the large volume of shares sold. But simultaneously, you have a broader group of executives and directors actively using their own cash to buy smaller blocks of shares on the open market.
So the selling is concentrated and structural, while the buying is widespread and intentional. They are basically buying the dip.
The nature of that recent dip is equally telling on the technical side. The stock dropped over 48% over a 13-week period, but it happened on remarkably low volume.
Like how low?
It was trading at less than half as stable, about 0.43 times its 3-month average volume during that slide.
I always look at low volume sell-offs as a sign of exhaustion rather than panic.
Precisely. When a stock price collapses on heavy volume, it means massive institutional players are rushing for the exits. When it drifts downward on low volume, it signals that the short-term traders who wanted to take profits have left. But the long-term holders simply aren't willing to sell their shares at those lower prices.
Right, it's a lack of buyers in a quiet period, not a stampede of sellers.
Exactly.
We have to keep our feet on the ground here, though. We have this $11 price target dream, we have confident insiders, and we have a technology that theoretically solves the ultimate AI bottleneck.
Right.
But the reality is the stock did just drop almost 70% from its highs. We really have to address the risks and the bear case staring anyone in the face who considers this space.
The bear case is substantial, and it revolves around two interconnected threats: valuation compression and shareholder dilution.
Let's tackle valuation compression first.
When a company is trading at a price-to-sales ratio of over 3,700, the market has already priced in flawless execution. There is zero margin for error in their business plan.
Not all.
If they announce that a prototype test failed, or even if they just announce that the 2027 commercialization timeline is slipping to 2028, the multiple will collapse.
Right.
The market will aggressively reprice the stock downward because the future cash flows are suddenly further away and less certain.
And the longer it takes to reach commercialization, the more dangerous the second threat becomes: dilution.
They're operating with negative free cash flow. Running advanced material science labs and maintaining global patents is incredibly expensive.
Yeah, you have to pay the PhDs.
Exactly. They have to keep the lights on and the R&D moving forward until those 2027 milestones generate actual licensing revenue.
And if you aren't generating cash from operations, you have to raise it from the capital markets, usually by issuing new shares.
Which inherently dilutes the ownership percentage of every existing investor. It is a known and practically guaranteed friction for companies in this phase.
It's like holding a winning lottery ticket that you aren't allowed to cash in for 3 years. And in the meantime, the company might tap you on the shoulder every 6 months and ask you to pay an extra fee just for the privilege of keeping your ticket valid.
That perfectly captures the agonizing reality of pre-revenue deep tech. You are constantly racing against the clock of your own cash burn.
Right.
If the technology takes too long to mature, the company might succeed scientifically, but the early investors could still lose out financially because their equity was diluted to nothing along the way.
So, summarizing the final verdict on Lightwave logic based on everything we've unpacked today, this is the definition of a high-risk, high-reward, speculative long position.
Without a doubt.
For an investor looking at a long-term view, say an 18 to 24-month horizon, it offers a truly asymmetric upside. If they successfully position their proprietary polymers as the solution to the most pressing physical bottleneck in the AI data center space, the licensing revenue could be astronomical.
And that's reflected in that bullish score of 7 out of 10 and that $11 price target.
Exactly. But that entire bull case requires them to flawlessly hit their 2027 production milestones without running out of runway first.
If we connect this to the bigger picture, this company is a perfect microcosm for the psychology driving the current AI boom. Investors are aggressively ignoring present-day reality in favor of future dominance.
The tangible metrics just don't apply. I mean, their price-to-book ratio is over 11.
The market places almost zero value on their tangible assets today. The desks, the computers, the current lab equipment. The entire valuation is an elaborate pricing mechanism for intellectual property and future architectural market share. It is a massive leap of faith, completely grounded in the physics of material science.
It really forces you to examine your own philosophy when you click purchase in your brokerage account, which leaves us with a fascinating final thought for you to ponder.
Yeah.
If a company's entire current billion-dollar value is based on what it might achieve in 2027, how much of the future is already fully priced into today's stock market? When you invest in deep tech, are you actually investing in a physical technology, or are you just investing your capital into a timeline?
This is the real question.
It really is. Anyway, if you find our talk useful, please consider subscribe, like, and comment underneath. And again, don't forget the VIP Algos link is below in the description. It's a huge help for navigating setups just like this one.
Absolutely.
Thanks for joining us on Smart Wealth with Joshua. We'll see you next time.